This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through, pick up where we left off. Hopefully maybe had a little coffee break or toilet break. Okay. Let's go through there and have a look at the rest of the framework. Before we do, just take a second to go through there and try and remember the previous 5 bits that we've gone through and done. Can you remember them? What was the first bit? First bit that we looked at was the role. Okay, excellent. Second bit was the objectives. Excellent. Third bit was the underlying assumption. And what was the underlying assumption? Yep, going concern. Then we went through and looked at the fundamental qualitative characteristics. What were the 2 fundamental qualitative characteristics that we had? Relevance, excellent, and faithful representation. Well done, excellent, very proud of you. Relevance, something is only relevant if it is material, and something is material by 2 things: by its nature or by its size. Excellent. Oh, well done, you're making me so proud. If you think about faithful representation, how do we ensure faithful representation within the financial statements? Yeah, tricky one, that one, wasn't it? We were looking there at substance and the economic reality. And then there were 3, weren't there, little subsections to ensure that things were faithfully represented, weren't they? Oh yeah, might have to look back at your notes of that one. Was it free from bias, complete, and free from error? Okay, excellent, well done. And then the last one that we looked at out of those 5 was the other qualitative characteristics, were the enhancing qualitative characteristics. You know what the question's going to be, don't you? Yes. What are the 4, if you like, enhancing qualitative characteristics we had? Was it understandability, comparability, timeliness, and verifiability, didn't we? Excellent. So there we go. Happy with that? Yeah, it takes a little bit of time, doesn't it? Question practice on this is fundamental, pardon the pun, fundamental qualitative characteristic. But the more you practice these questions, it becomes so easy. Okay. Next one that we're going to go through and look at is looking at the element. So that gives us an E. Okay. And this goes through there and gives you definitions of the elements that appear within those financial statements. So here we're looking at the assets, liabilities, equity, income, and expense. Okay. So what you've got there is these need to be learnt. So an asset is a resource that is controlled by an enterprise. That's the key word, I think, within an asset. You don't necessarily have to own it to show an asset. You just have to control it. So when we get and look at leases in F2, that's a prime example of whereby you may not own an asset, but you have control over it. Okay. So controlled by the enterprise as a result of a past event from which you get future economic benefits to flow to the enterprise. So if you think about PPE, so land or buildings, plant and machinery, fixtures and fittings, yes, you own it because you bought it, but you control it, don't you? You can control how to use it. The past event is the purchase of the asset, and you're going to get future economic benefits. You're going to generate future profits and get future cash inflows. Liability is looking at an obligation to transfer economic benefit as a result of a past event. So a liability, there has to be an obligation. You are due contractually, maybe legally, depending upon the situation within the scenario, to make a payment. Okay, so you have an obligation as a result of a past event that will give you an outflow of economic benefit if you so wish. Equity, the equity definition will probably be updated at some point in the future, but for now, your equity is the residual amount found by deducting all liabilities of the entity from all of the entity's assets. It's crazy. But what you've got there essentially is it's saying that, look, your equity is equal to your assets less all of your liabilities, which is that From the statement of financial position, that's what your equity is, isn't it? But we've seen shares in your certificate level with regards to equity shares and preference shares, talking about ownership and non-ownership. Now, to me, equity is all about ownership, isn't it? And that's not contained there within the definition, within the framework. But don't go with my definition of equity with regards to ownership. Equity is essentially the net assets. It's the assets of the entity deducting all the liabilities. The next two, income and expense. Boy, oh boy, oh boy. They are the most complicated, fancy definitions that you possibly have within the entire universe. Income, increases in economic benefit in the form of inflows or enhancements of assets, or decreases in liabilities that result in increases in equity other than those relating to contributions from equity participants. What on earth is all that about? Essentially, what you've got there is that your income gives rise or derives from either an increase in your assets or a reduction in your liabilities. Okay. An increase in assets is a good thing, isn't it? So that's assets, okay, or income. A reduction in a liability, it's a good thing, isn't it? Okay, so again, that's like a little bit of income. If you're looking at expenses, that's essentially the opposite way round, okay, in that your expense is either a reduction within your assets or an increase in your liabilities, isn't it? Okay, so essentially that's a bad thing, isn't it? A reduction in your asset, if you like, depreciation, that's an expense, isn't it? An increase in your liabilities as you charge interest on a loan, that's increasing your liabilities. You need to pay that interest, and that interest is an expense, isn't it? It's a bad thing, isn't it? So decreases in assets, increases in liabilities are bad, hence expenses. Increases in assets or reductions in liabilities are good, and therefore income. Okay, that's keeping it in its most simplistic form. Then what you have is the recognition. This is very important, particularly when it comes to looking at intangibles later on within the syllabus, because a transaction may meet the definition of an asset, but in order to record the value of the asset, it needs to be enabled to meet the recognition criteria. So to record it within the financial statements, it has to pass not just the definition, but also meet the recognition criteria. And the recognition criteria there is that you want, is it probable future economic benefits? And as well as probable future economic benefits, you want it to be measured reliably. Okay, so you can actively assign a valid number to the asset, the liability, the equity, income, or the expense. In terms of probable future economic benefit, we're saying that it will be more likely than not that there will be an inflow, or more likely than not that there will be an outflow. So when we come to F2, we start to look at provisions, which start to look at a liability, whether or not we can recognize that liability within the financial statements. From an F1 perspective, again, when we come in to look at intangibles, when we look at intangibles, you can only recognize an intangible provided that you can measure it reliably. So there are some intangibles that we will see, such as brand names, that we cannot measure reliably and therefore can then not be recognized within the financial statements. It may meet the definition of an asset, but if it can't be measured reliably, we're not going to make up a number and just throw it within the financial statement. So there's two things that we need to look at there: probable future economic benefit and measure reliably. If that's the case, then it can be recognised. The last one of the 8 is going through there and looking at the M. Is that there your measurement? So what you've got there is that there are different measurement bases that entities can adopt for different transactions. Okay. The most common is your historic cost, which is what we go through there, don't we, and use in property, plant and equipment. You record the value of the asset based upon what you pay to acquire that asset for. Okay. The problem with that historic cost method is that that cost is very quickly out of date, isn't it? If you think about a building, you have a building, it might have a useful life of 25 years. You know, if you're into the 20th year of that building, its historic cost is 20 years old, isn't it? So that can become very quickly out of date. And if it's out of date, it might not go through there and faithfully represent the transaction that you entered into. Okay. So we might need to go through there and adjust it, which is when we bring in the revaluation model, isn't it? Okay, but we'll touch upon that in a moment. So if the current cost method is not particularly appropriate, what you could do there is look at the current cost method. So what you could do there is look at the cost today. Okay, so we're thinking about inflation. Imagine you've bought some inventory. You know what the value of the inventory was when it was bought. That may be a year ago. Okay, it could be 6 months ago. In terms of your property, plant and equipment, that could be several years ago, couldn't it? So maybe what you might want to do is you might want to update that cost for what it currently would be paid for today. So if you like, incorporating inflation, and that's where it essentially goes through, and we'll touch upon it after the examples, is whereby we think about a concept of what is referred to as capital maintenance. You want to update your historic cost to go through there and reflect current cost to give you a fairer presentation of the results that we have within the financial statements. So if you like, to incorporate inflation. But in most developed economies, inflation is under control. There's no, if you like, hyperinflation, whereby you have excessive amounts of inflation. So we tend not to worry too much about the current cost method of measuring items within the financial statements. Okay, the current cost isn't going to be so out of date so quickly. Okay, what you've got there is your realizable value. So looking there at what you could go through there and sell it for today. Okay, so current cost is looking at purchasing it. Realizable value is what you could sell it for. Okay, so again, thinking about inventory, you value at the lower of cost, so its historic cost and its net realizable value. That is a measurement basis, what it could be sold for today. And if the NRV is lower than the cost, then you would record it at that lower realizable value, because it gives a more faithful representation, doesn't it, of the economic reality of what would happen within the business. You will sell that inventory at below its cost, so therefore recognize it at its realizable value. And the other one you have there is your present value. So maybe you have the settlement of a liability, or you are due cash from a customer in several years' time. What you receive in several years' time may be materially different to what you expect to receive or pay today. So therefore discount it back to present value. But again, notice that word that I used, materiality. Only discount things back to present value if it is materially different. Discounting is complex. You've seen that within other subjects that you do. So therefore, don't overcomplicate it. Make sure there that you only discount it if it is material, because if it's material, it is relevant to the users of the account, isn't it? So again, what you need to do there is you need to learn those different measurement bases. As we said, we'll touch upon capital maintenance a little bit later on. Before I allow you to go through there and have a go at two ridiculously easy questions, so easy that I won't even go through them, what I would like you to do is just have a think about the mnemonic that we could potentially have generated. Okay, because what you've got there, haven't we? If I go through and take the letters that we had, I think we had, was it an R? We had there, was it an O? So role, objective. We had, was it the assumption, didn't we? We also then had the fundamental qualitative characteristics. We then had the enhancing qualitative characteristics. We then had the elements. We then had, is it the recognition? And we then had, was it the measurement? Okay. It may help you, I don't know. Okay, but could you generate a mnemonic from those 8 letters? Maybe try this. See what you've got. I think you've got the word, is it free? Okay, free. And is it Rome? Okay, so what you've got there is to remember what is contained within the framework. You've got there, is it free? Rome. So you can roam wherever you so wish. Okay, you can go wherever you want. There's no restrictions on borders or anything like that, and you can go wherever you so wish in the world. Okay. So what you've got there, it's like free roam. It's like, well, what does all that stand for? It may help you, it may not. It's up to you. F is going through there and thinking about your fundamental qualitative characteristics. The R is the role. Okay, the other R, if you like, is recognition, isn't it? E, again, that's going to be a little bit challenging, isn't it? Okay, you've got is it the elements? So assets, liabilities, equity, income, expenditure. The other E is the enhancing qualitative characteristics. Okay. O, can you remember what the O stand for? Yep. Was that the objectives? Okay. The A is a bit of a cheat because the underlying assumption, which is there, isn't it, as going concern, and then M is the measurement, isn't it? So looking at historic cost, current cost, realizable value, and was it there your present value? Okay. Which, looking at your current cost talks about, is it your capital maintenance, which we'll touch upon after you've done those 2 examples. Okay. There you go. Have we got the 2 examples? Then have a look at capital maintenance as and when you get the time. Okay. But maybe before you do the capital maintenance stuff, have a practice at the questions in the revision kit. Work through the chapter in the study text that you're working through, and hopefully you'll find that this stuff, although it's very dry and very basic, it should be some really good marks within the exam. So if you get 2 or 3 questions within the exam, you should be pretty happy. Okay. Enjoy the questions, and I'll see you when we get to capital maintenance.